my name is Scott Dahl. I'd like to thank you again for tuning in to one of my podcasts. If you haven't seen the previous podcast, what I do is I build a knowledge base, and I will explain to you why I believe with sound reasoning that we're in a long-term bear market. We're in a secular bear market. Why is the market going up? Because we're in a cyclical up move. So we're in a shorter-term up move in a longer-term sideways bear market that could run for years. And I attempt to prove that in previous podcasts. So where are we at right now? Well, I'm going to use technical analysis to show you what I believe is going on. I'm going to talk about breadth again. I've mentioned breadth in previous podcasts. What breadth is participation. It's the number of stocks that are going higher as the market goes higher. So if you have a lot of stocks that are participating, a lot of stocks that are going higher as the market increases in value, that's a positive sign, because it's a lot of strength. And it's the analogy I always use is a general going into battle. If he has his soldiers behind him, he's probably going to win that battle. If he doesn't, if he has very few soldiers, he's probably going to lose. And that's breadth. The index would be the general, the stocks would be the soldiers. So what we've had this phenomenon of 7 or 8 stocks driving this market higher, and all through 2023, and now into 2024. It's the same thing. Why is it so vitally important that we discuss it now? Because everybody's looking at breadth. Breadth is rolling over. I'll show you what that means on the charts. Everybody is really concerned about the breadth. And when I say everybody, I mean technical analysts, money managers, fundamental analysts, everybody on the street. They're looking at this breadth, and the breadth is waning. It's rolling over. That's a negative. However, I don't believe that these folks, I think they're too myopic. I don't think they're looking at the longer term picture. I don't think they're looking at the fact that this cyclical bull market is in a very strong uptrend. Also, keep in mind that it's logical to see a sell-off. I mean, we're almost through half of the year. I'm recording this on June 26th. We're almost through half the year. The New York Stock Exchange Index is up almost 6.75%. The S&P is up over 14. The Standard & Poor's 500 is up over 14.5%. And the NASDAQ, the tech-laden NASDAQ, it's up even more. So it would be logical that we would see some form of a sell-off. Secondly, is remember that an election year is a very strong year. You typically have a good fourth quarter. You have a strong summer, which is counter to the typical seasonal pattern. So election years, you have a strong summer and you sell off in September, October, and have a big rally at the end of the year that works into the following year. Are we going to see that pattern? Well, it's a probability because we've seen it in the past, but there's certainly no guarantees. Anything could throw the market off a geopolitical event. So what we're going to do is let's get into the charts. There are 2 technical analysis tools that I'm going to present to you right now. One is called the Fibonacci retracement. The other is called a triangle. It's a triangle. Another word for it is going to be a pendant. So let's talk about the Fibonacci sequence. So what I have up on the board is I have a set of numbers, and I'm going to tell you who he is. Leonardo Fibonacci, he was a 13th century Italian mathematician, and he discovered these reoccurring numbers in nature. I mean, all phenomenon of nature. The nautilus shell, it forms its shell using the Fibonacci sequence. The rabbits multiply in the Fibonacci sequence. A sunflower has 89 petals, 34 running one way, 55 are running the other. He lined up women, and he measured hundreds of women, and he found that the Fibonacci sequence was present in their physical proportions of their bodies more often than not. So he did a lot of work with this. If you look at the numbers on the screen here, you see the Fibonacci sequence. So he started with a 1, then a 3 and a 5, 8, 13, 21, all the way out to 144. It can even extend further, but these are the primary or the most important numbers. Now, if you take 5 divided by 3, you come out to 0.618. If you take 8 divided by 5, you come out to 0.618. So if you take the higher number divided by the number before it, you come out to 0.618. Why is this important? Because 0.618 is the golden mean. It's the golden rule. The Parthenon was built using the golden mean. Pyramids were built using the golden mean. It has continued to reoccur over and over and over again in human activity. How does this apply to the stock market? Well, the stock market, as I've expressed over and over, is a psychological mass. It's what all humans believe that the price of the market or the price of the asset is worth at that specific time. And we can use the Fibonacci sequence to determine retracements or the sell-offs in the market and where the support might be, where it might stop. So let's take a look at the charts, and I'll explain this in detail. First chart we're going to take a look at is the chart of the Standard & Poor's 500. Standard & Poor's 500 is in a very strong uptrend. This is a daily chart. Each one of these lines represents a day. A green is an up day. A red is a down day. If it goes lower, where's it going to stop? Well, the logical points would be this trend line. You can see that it's hit this trend line a couple of times, or maybe down in this low. But if it sells off, our objective would be 53.73, another 100 points lower. I'm not saying it's going to, but I'm saying that, it's time to take a break. Let's look at its second chart. This is the NYSE. How is it different than the S&P 500? S&P 500 is 500 stocks. It's predominantly, almost all the stocks are large company stocks. The NYSE index is 2,038 stocks of different sizes. So it might be more representative of what all the stocks are doing. So you can see that it's been in a sideways formation for a while here, and it seems to be in just this congestion phase, not going one way or the other, but certainly not making new highs, which would be a positive in this. So now let's look at the breadth. Here's the breadth on the New York Stock Exchange. So the breadth is turned down. The breadth turned down in May, but in mid-May, the market was still going higher. So the breadth is turned down. So we have less participation. So this is what everybody's concerned about. And this is a rollover in breadth. It's a lower move in breadth. Less and less stocks are moving higher in the New York Stock Exchange. Typically, when you have breadth that rolls over, the index can continue to go higher for a relatively long period of time, 9 months, 12 months, 15, 18 months. So this drop in breadth, I think, coincides with the drop in the price. It's not good, but I don't think it's overly concerning at this point. I think there's a good possibility we're experiencing a sell-off, a correction, which would be likely. Where's it going to go? This is why I introduced the Fibonacci sequence. The three most important numbers to me in the Fibonacci sequence are 23.8, 50, and 61.8. It's basically on a retracement, it's 1/3 back, 50% back, or 2/3 back. And these are the three most important Fibonacci numbers. So you can see that breadth came down earlier in the year. It went down and tested this support level, this 23.8% Fibonacci number, and it bounced off of it. Also, this support level coincides with this high right here, which was resistance and then has now become support. So this is a strong level of support, this 23.8% back. How do I measure this? Well, I take the bottom here, the start of the move, to the top of the move, and then that gives us these retracements, 23.8%, 50% back, 61.8% back, which is, of course, the golden mean. And so the support should be here where this congestion or this support area is here. See those red and green daily bars? And then that coincides with this Fibonacci retracement. So that's what we're shooting for. It would be ideal if we would see that either hit and turn around, or if perhaps it would make a higher low and then continue higher. So it can be ominous, but breadth and price typically, in my experience, don't coincide. Breadth turns down and price can continue to go higher. That's one important reason why you want to make sure you're holding the strongest stocks, because the strongest stocks should hold in when we see any kind of volatility or any kind of sell-off. So let's look at one more chart. This is the RSP. I've talked about this before. This is the equal weighted S&P 500. What I mean by that is it takes every stock and gives every stock an equal weighting, all 500 of them, whereas the S&P 500 is market cap weighted. This equal weighted RSP, it might give you a truer idea of what all the stocks in the S&P 500 are doing. Well, this is what is called either a triangle or a pennant. Why is it a pennant? Well, here's the staff, here's the pennant. Typically, you would expect this to break out to the upside because that is the direction of the previous trend. It breaks down through the trend line, well, that would more than likely indicate that we're going to go ahead and go down further, maybe test this level here, maybe come down into this congestion phase. So that's it. That's the breadth. That's where we're at this moment. Everybody's overly concerned about it. It's not a good thing that breadth is going down. However, this for me is a sign of a correction until we see further progress to the downside. Then we would have to change our view. Let me know if you have any questions on this. I appreciate you tuning in. You can reach me 949-497-6366. It's Scott@DowCapitalAdvisors.com if you'd like to email me. If you'd like me to take a look at your portfolio, perhaps I could give you a second opinion. That would be no obligation. I'd be happy to do it or answer any questions for you that you might have. Thank you again for tuning in, and I look forward to the next one.